Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 2. This is Section D2. This is an application topic. Determine tolerable misstatement or performance materiality for the purposes of assessing the risk of material misstatement and determining the nature, timing, and extent of further audit procedures in an audit of an issuer or a non-issuer. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it's free, it is 1 hour, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. After you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. SuperfastCPA Pro members get access to a lot of great stuff, including the Pro course where we explain in depth exactly what you need to be doing every day to pass the exams, but they also get access to the full versions of these YouTube videos. So in today's video, we're only going to be going over 5 questions, but SuperfastCPA Pro members will get access to the full 10-question video when we post it in the members forum. So if you like this and you like our other videos, just remember that if you become a Pro member, you'll get access to the full versions so you can get a little bit more help and a little bit more understanding. Now with all that, let's dive straight into the questions. All right, here we are at question 1, and one thing I will say is you hopefully will have watched the previous video to this one where we talked about calculating overall materiality, because that's a pretty good base to calculating what we're going to calculate here. But with that, let's dive in. One thing I always like to point out is you want to read the last part of the question first. This will give you context for what the rest of the question is talking about, especially with these big calculation problems where you're reading through a whole bunch of numbers and a whole bunch of information, and you might not even know what you're supposed to be doing until the very end. Instead, read the very last part of the question so you do know what you're supposed to be doing from the beginning, and then that will help you get through questions more quickly. And of course, the whole idea behind this is to be faster on test day. This is a test day strategy. So let's go ahead and do that. Based on the firm's guidelines, what is the most likely performance materiality? Again, think of this as if you were on test day. You read that last sentence and you immediately know you're dealing with performance materiality because you have no idea what you're going to be seeing in the questions. So as soon as you get to this question, you now know you're dealing with performance materiality. That is a big deal. Now let's go to the top. An auditor is determining performance materiality for a client's financial statements. The audit firm's guidelines state that performance materiality should be set between 60% and 85% of overall materiality, with the exact percentage depending on the assessed risk of uncorrected misstatements. The auditor has determined that overall materiality is $900,000 and expects a low likelihood of uncorrected misstatements. Based on the firm's guidelines, what is the most likely performance materiality? Okay, so if you have no idea how to calculate performance materiality when you see a situation like this, that's okay. We are using these questions to learn what the questions are probably going to look like and how to do the things we're supposed to be doing for test day. So again, if you don't know how to do this, that's okay. We will look at the explanation, but if you want to give this a try, pause the video, do the calculation, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. C, $765,000 is going to be the performance materiality. So let's walk through this. This might have been a little bit confusing if you've never seen this before, but it's pretty simple and straightforward once you understand what you're supposed to do. So let's go through it. Performance materiality is an amount set below overall materiality to reduce the risk that uncorrected and undetected misstatements, when aggregated, exceed overall materiality. It helps ensure that financial statements remain free from material misstatements even if some errors are not detected. In this case, the firm's guidelines set performance materiality between 60% and 85% of overall materiality, with the percentage selection based on the likelihood of uncorrected misstatements. And you may very well see a question similar to this. If risk is high, the auditor uses the lower end of the range, closer to 60%. If the risk is low, the auditor uses the higher end of the range, closer to the 85%. Since the auditor expects a low likelihood of uncorrected misstatements, they would use the higher end of the range, so 85% is the high end. So again, because we don't have any more specific information, we're just assuming we're using the higher end. So 85% of $900,000 is $765,000. That is the performance materiality. And I just want to make sure that that's clear why that's the case. Remember, the idea behind materiality is to make sure that something gets caught that would affect the decisions of financial statement users if it was included or not included in the financial statements. And so if the risk is high that there is uncorrected misstatements, you want to set your materiality or performance materiality low so that you have a low threshold for errors, so that you're more focused on making sure there's no errors because you don't want to go over that low threshold. And then the other way around. If the risk is low, then you can use the higher end of the performance materiality range because you're less worried, you don't have to do as much, you can have materiality set higher so that, there's more room for errors because it's not as big of a deal. So that's kind of the idea behind performance materiality. You're setting it as a part of overall materiality. Now let's go to the next question. Okay, here we are at question 2. Based on the firm's guidelines, what is the most likely performance materiality? Let's go up to the top. An auditor is establishing performance materiality for a client's financial statements. The audit firm's policy states that performance materiality should be set at 50% to 80% of overall materiality, with the exact percentage based on the assessed risk of uncorrected misstatements. The auditor has determined that overall materiality is $1,200,000 and believes there is a high risk of uncorrected misstatements. So again, based on these guidelines, what is the most likely performance materiality? This is very similar to the previous question, so if you learned what you needed to learn from the first question, you most likely can do this one even on your own. So pause the video, do the calculation, and when you're ready, come back, we'll look at the answer together. Okay, here we are at the answer A, $600,000. Again, this one should have been pretty straightforward based on what we learned from the first question. Performance materiality is, again, set below overall materiality to reduce the chance that undetected or uncorrected misstatements, when aggregated, cause the financial statements to be materially misstated. The firm's policy states that performance materiality should be between 50% and 80% of overall materiality depending on the risk of uncorrected misstatements. And again, this is very similar. If the risk is high, the auditor is going to use the lower end of the range, most likely close to 50%, to be more conservative. If the risk is low, the auditor should use the higher end of the range, closer to the 80%. Since the auditor believes there is a high risk of uncorrected misstatements, they would use the lower end of the range. So 50% is the low end, and again, because we don't have more information than this, we're just assuming the lowest end of the range. 50% of $1,200,000 is $600,000, so that's what we would set the performance materiality to for this case. Again, don't think of it as there's a high risk, so we have to set the materiality high. It's actually the opposite. If there's a high risk of uncorrected misstatements, you want to set the performance materiality lower so you are more likely to catch the things and the errors that are going to cause materiality errors. Now with that, let's go to the next question. Okay, here we are at question 3. Based on the firm's guidelines, what is the most likely performance materiality? Okay, pretty similar question all throughout this, but this question is a little bit different than the previous two questions. An auditor is determining overall materiality and performance materiality for a client's financial statements. The audit firm's guidelines state that the overall materiality should be set at 4% of total assets, and that the performance materiality should be set between 60% and 80% of overall materiality. The client reports the following financial data: total assets, $5,200,000, total revenue, $7,800,000, and net income of $910,000. The auditor expects a high risk of uncorrected misstatements. So again, based on the firm's guidelines, what is the most likely performance materiality? Now, based on what we've learned so far, and if you watched the previous video about calculating overall materiality, I'm going to say this one more time. If you just read what is stated here, very frequently, you'll be able to figure it out when it comes to materiality questions just based on the information they give you. You don't really have to think too hard about it. You just have to follow what they say. Again, think about what's said here, pause the video, do the calculation, and when you're ready, come back, we'll look at the answer together. Okay, here we are. The answer is A, $124,800. That is the performance materiality here. So this question was a little bit different just because we had to also calculate the overall materiality, but that probably wasn't too difficult. So let's walk through this. First, we calculate the overall materiality. They say that the overall materiality is 4% of total assets. Total assets was $5,200,000. Multiply that by 4%. That's $208,000. That is the overall materiality. Now we can calculate the performance materiality. Performance materiality is set between 60% and 80% of overall materiality. We've done this before. Since the auditor expects a high risk of uncorrected misstatements, they would use the lower end of the range. So instead of using 80% or somewhere in between, again, we're just assuming the low end of the range. So 60% of $208,000 is $124,800. That is the performance materiality in this case. Again, because there is a high risk of uncorrected misstatements. If it had been the other way around and there was a low risk, then we would have used 80% instead of the 60%. So that was another question, learning how to calculate performance materiality. Now let's go to the next question. Okay, here we are at question 4. Based on the firm's guidelines, what is the most likely tolerable misstatement for accounts receivable? Okay, we're talking about tolerable misstatement now. Let's go through this and we'll start learning a little bit about that. An auditor is determining tolerable misstatement for a client's financial statements. The audit firm's guidelines state performance materiality has already been determined to be $250,000. Tolerable misstatement for an account should be set between 50% and 80% of the performance materiality, depending on the risk of misstatements within that account. The auditor is evaluating accounts receivable, which is considered a low-risk account with strong internal controls. So again, based on the firm's guidelines, what is the most likely tolerable misstatement for accounts receivable? So this is pretty similar. It's probably, you can pretty much just apply what you learned about performance materiality to this. So pause the video, think through this, and when you're ready, come back, we'll look at the answer together. Okay, here we are. The answer is C, $200,000. Let's walk through this and let's understand what tolerable misstatement is. Tolerable misstatement is the maximum misstatement an auditor is willing to accept in an account without requiring further action. It is set as a percentage of performance materiality, with higher risk accounts assigned a lower percentage and lower risk accounts assigned a higher percentage. Since accounts receivable is a low risk account, the auditor would use the higher end of the range, 80% of performance materiality. So $250,000 multiplied by 80% is $200,000. A higher tolerable misstatement means the auditor may use fewer detailed tests and rely more on analytical procedures. If the risk were higher, a lower tolerable misstatement would require more extensive testing and larger sample sizes. So you can kind of see the difference there. If there's a high tolerable misstatement, again, that would mean that they are thinking that they can have a higher materiality threshold, meaning they might not have to do quite as many tests. They might not have to do as many substantive procedures. Whereas if the risk is higher and they would have a lower tolerable misstatement, then they might have to do deeper testing, more substantive testing to make sure that they're not missing anything that could cause an error or cause materiality in the financial statements. So again, tolerable misstatement is basically is kind of a subset of performance materiality. It's basically just performance materiality applied to specific accounts. Performance materiality is still kind of general. It's still kind of for the financial statements as a whole. So there's overall materiality, which is the materiality for the whole financial statements. There's performance materiality, which is just set below overall materiality. But again, it's still kind of overall the financial statements. And then there's tolerable misstatement, which is basically the performance materiality, but you start applying it to high risk or low risk accounts. Now with that, let's go to the next question. Okay, here we are at question 5. Based on the firm's guidelines, what is the most likely tolerable misstatement for accounts receivable? Let's go up to the top. An auditor is determining tolerable misstatement for a client's financial statements. The audit firm's guidelines state that tolerable misstatement is typically 75% of overall materiality, but this percentage is reduced to 55% if both of the following factors are present. The account has a history of material misstatements in prior audits, and the account balance has increased by more than 30% compared to the prior year. The auditor has determined overall materiality to be $500,000 and is evaluating accounts receivable, which has the following details. Prior audits have identified several material misstatements in this account, and the current year's accounts receivable balance is $2,600,000, up from the $1,900,000 in the prior year. So again, based on the firm's guidelines, what is the most likely tolerable misstatement for accounts receivable? Now, that is not a typo. You might be thinking, why are we doing tolerable misstatement? We don't even know the performance materiality or how to calculate the performance materiality. Don't worry about it. Just calculate it how you think you would calculate it. And when you're ready, come back. We'll look at the answer together and I'll explain a little bit more. Okay, here we are. The answer is B, $275,000. So let's dive into this. Some firms do not explicitly set performance materiality and instead assign tolerable misstatement directly as a percentage of overall materiality. And you very well may see that in a question or in a sim. It seems like occasionally they might use tolerable misstatement or performance materiality kind of interchangeably, even though technically they're not necessarily the exact same thing, but they're very similar. So again, you might sometimes see it just go straight to tolerable misstatement instead of having to calculate performance materiality. So I just wanted to kind of include that in this question. In this case, tolerable misstatement is normally 75% of overall materiality unless both risk factors are present, in which case it is reduced to 55%. The auditor must determine whether both conditions are met, and it's pretty easy to tell. History of material misstatements, we were told that, yes, past audits found material misstatements, so there's a history of that. The balance increased by more than 30%. Yes, that also happened because the increase, which is $2,600,000 less $1,900,000 divided by $1,900,000, was 36.8%. So they had an increase of greater than 30%. So that means that they also meet that factor condition. So since both conditions are met, they're going to apply the lower percentage because there is a higher risk of uncorrected misstatements. So 500,000 multiplied by 55% instead of the 75% gives us $275,000 of tolerable misstatement. A lower tolerable misstatement, again, means the auditor will increase sample sizes and perform more detailed substantive testing to address the heightened risk. And again, that question was kind of just there just in case you kind of get confused by that when you're studying, or maybe if you see that on the exam and you're like, wait, I'm supposed to be calculating performance materiality before I calculate tolerable misstatement. Sometimes it seems like it's kind of interchangeable. Technically it's not, but it seems like sometimes in the questions you might see that. So just remember, you kind of calculate it basically the same way. So sometimes you might have to calculate performance materiality and tolerable misstatement, and sometimes you might just have to calculate tolerable misstatement. Now with that, we've learned a lot in just 5 questions. Before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 questions trying to teach you how to calculate performance materiality when there is that range and when there's low risk of uncorrected misstatements, or maybe when there's high risk of uncorrected misstatements. Again, whatever you might see, these are the things you notice throughout the questions. So you write them down in your own words as the pillar topics, the key points that you need to know for the exam based on the questions you did. And as you're doing this each day, you're building your own personal repository of the most important things you need to know for the exam based on the questions you did in your own words. Now with that, let's go to the pillar topics for this video. Okay, here we are at the pillar topics. Let's just dive straight in. First off, performance materiality is a percentage of overall materiality and is set lower when the risk of uncorrected misstatements is high, requiring more detailed audit procedures. And the opposite of that is true. If the uncorrected misstatement risk is low, then you might not have to do as many detailed audit procedures. Tolerable misstatement is often set as a percentage of performance materiality, with lower risk accounts receiving a higher percentage and higher risk accounts receiving a lower percentage to reflect audit risk. Some firms assign tolerable misstatement directly as a percentage of overall materiality, skipping a separate performance materiality step. You may very well see that. Tolerable misstatement may be adjusted based on risk factors such as large account fluctuations or a significant percentage of total assets, requiring auditors to determine whether those factors apply. And then finally, a lower tolerable misstatement, and this kind of is similar to a low or a high performance materiality, a lower tolerable misstatement results in more extensive audit procedures, including larger sample sizes and more detailed substantive testing, while a higher tolerable misstatement allows for fewer detailed tests. Now, don't get confused or think that if you have a low risk that you don't have to do any tests. That's pretty much never the case when it comes to auditing. You just might not have to do as extensive of tests or as many, but you still almost always, if not always, have to do substantive tests to make sure that you're doing the audit correctly. Now with that, we've gone over the pillar topics and the first 5 questions for this video. Remember, in this YouTube version, we're only going over all that. We're not going to go over the next 5 questions, where SuperfastCPA Pro members are going to be able to see the next 5 questions so that they can get a little bit more practice and a little bit more understanding. So if you like this and you like our other videos, remember to become a SuperfastCPA Pro member and you'll get access to the full 10 question, usually it's 10 questions, of these walkthrough videos. Now, before you go, make sure to check out our free 1-hour webinar training on SuperfastCPA.com. Again, it's free, it's 1 hour, and we will teach you the key ingredients to passing the CPA exam, and it's a great path to learning about becoming a pro member, so check that out. And if you liked the video, make sure to like it and leave a comment. I hope this video was helpful, and I will see you in the next one.